Hi, it's Steve Lingard from CI GAM. Equities rallied and fixed income sold off sharply during the first quarter as resilient economic data and vaccine rollouts supported investor optimism. A combination of record monetary and fiscal policies supported growth and inflation expectations, finally resulting in bond markets reacting. Small cap and value factors performed the best in this environment, with small caps up 10% or more and global value beating global growth by 5%. On a regional basis, non-U.S. stocks outperformed except for emerging markets, which lagged during the period. Broad Canadian fixed income using the FTSE Universe Index as proxy fell over 5%. The Mosaic balanced ETF portfolio rose 2.7% in the quarter, with overweight positions in equities and in particular value equities more than offsetting the significant drag from bonds. This equity factor volatility is expected to continue as investors evaluate the dominant performance of growth and momentum factors over small and value factors from the past decade. The recent COVID recession and recovery has improved performance of these long-suffering factors, but can this nascent outperformance be sustained? A lot will depend on if we can finally get a more normal economic recovery, meaning economic growth achieving trend and inflation pressures picking up. We believe this is happening for the first time since before the last recession during the 2007 Great Recession, meaning investors should continue to position for this rotation. Global growth and earnings forecasts continue to be revised up, which often happens at this stage of the cycle. This preference leads us to prefer non-U.S. equity markets, which offer more compelling valuations and earnings growth this year. Secular growth stocks and technology specifically dominate the U.S. market, and while we expect to see solid earnings this year from the U.S., its low weighting in cyclical sectors gives it a disadvantage relative to other markets with more non-tech cyclical exposure like financials, energy, industrials, and materials. Finally, we will maintain our gold bullion and gold equity exposure in addition to hedged inflation-protected securities to guard against a potential overshoot in inflation as it normalizes. Thank you.